Good afternoon, everybody. Welcome once again to the weekly live webinar presented by Affinity Federal Credit Union. My name is Oscar Cordova, and I'm the External Affairs and Financial Education Manager here at Affinity, in charge of the financial education efforts for the areas that we serve. Today's topic is credit score and enhancement, understanding your credit. So we're going to be learning today about what's a credit score, how to manage our credit responsibly, and the importance of having good credit, okay? Before we begin, a brief disclaimer: all of the information provided to all of you this afternoon, the information is intended to be for educational purposes. It's intended to be informational. It is not intended as legal, tax, or financial advice. Every person's circumstances are different, and if you want to have a one-on-one conversation with a professional, financial professional, tax consultant, or legal counsel, feel free to reach out, and I'll be more than happy to put you in touch with somebody that can have this conversation with you. All right, let's get the show rolling. A quick quote before we begin: procrastination is like a credit card. It's lots of fun until you get the bill. And unfortunately, a lot of people, when they get their first piece of credit or they get a credit card, they may fall under the misconception that a credit card is free money. It's money that is there to be used without actually thinking that the money needs to be paid back. And not only be paid back, it needs to be paid back with interest. And so having good credit and being able to manage our credit is going to lead for us to develop the right behaviors to use our credit cards and other loans responsibly. But first, let's start by defining what a credit score is. So a credit score is a number that gives lenders a snapshot of your creditworthiness at a particular point in time. Why a snapshot? You guys may ask yourself, what do you mean? What do you mean a snapshot? And the reason it's a snapshot is because a credit score changes from 1 month to the next, from 1 week to the next, depending on your behavior and the cycle of the reporting agency. So it's a snapshot because when a bank, a credit union, or a financial institution pulls your credit because they're looking to provide you or approve you for a loan, the score will show how good you are at that particular point in time. That score may be different in the following month, depending on your behavior. And so credit unions and banks and financial institutions use scores, these scores, to extend credit to somebody. So if you have good credit and you pay your creditors on time and you're not late, that means that you are you are a good client. You could be a good customer. So the credit score will be attached to your credit report, and your credit report will show your behavior with other creditors, right? So if you have good behavior, your credit score is going to speak volumes about you in a good way. On the other hand, if you are behind, if you're not making payments, if you have collection accounts, that's also going to be reported on the report, and your score will reflect your behavior. And at that point, the financial institution may feel that they may not want to lend money to you because you may be a problem customer. A bank, when they are underwriting a loan, one of the purposes of underwriting a loan is to risk mitigate. So they're trying to make the best loan out there, and they're trying to give money to someone that eventually is going to pay the money back. So that's risk mitigation, right? All right. So credit scores also influence the credit available to you. So the better the score, the better terms you're going to get on different loans in regards of the term of payment. So how long you're going to be making payments for, in regards of the actual payment, how high or low the payment is going to be, and the rate. So the rate is very important, right? and people with better scores will be able to enjoy the best rates that a bank or a credit union may offer. Someone with a so-so score may still be approved for the loan, but not at the best prime rates. Okay. Having credit available will also help you through the financial shock of certain life events, such an emergency. So when I teach budgets, I mention and I like to stress the fact that everyone should have an emergency fund, which is an account where you can put some money away for that rainy day. When we wake up in the morning, we're not thinking about I'm going to get a flat tire today, or I'm going to get sick today. But things happen to all of us. And if we get sick, guess what? Now we have to go to the doctor. Now we have to pay a co-payment. Now we have to buy medicine. Same thing with your vehicle. If you get a flat tire, now you need to tow the vehicle to a tire place. You need to buy a new tire or get the one you have fixed. And where are you going to get this money from? Hopefully from your emergency fund. All right. But for all of us who don't have an emergency fund established, having credit is the second best thing that could happen to you, because having a credit card will allow you to put this emergency on the credit card. So that means that you're getting out of this emergency situation. And also a credit card allows you to pay for this expense over time. The only problem with this is that you need to be aware of what is the interest rate and the fees that you're going to be paying for however long you decide to pay this debt back. So if you pay what you spent on your credit card within 30 days, you don't have to worry about interest, because you're paying it within the same billing cycle of your credit, right? Let me rephrase that, not 30 days. Within the billing cycle, because you could be mid-cycle and it could be only 15 days, not 30, but within the same billing cycle. If you decide to extend the paying back this credit card for 5, 6, 7 months, you can do so, but please be aware of how much money you're going to be paying extra in interest and other fees. Okay. All right. So what does a credit score consider? So this is kind of like a pie chart that will give you kind of like a sense of how the importance of different aspects on your credit. So you guys can see 35% goes to payment history. And we'll go in a little bit more detail in a follow-up slide, but payment history is paramount. How you pay other creditors is how you're going to be perceived by other financial institutions. So if you pay on time, that will be reflected under your credit report, and your credit score will reflect that as well. 30% for amounts owed. So you want to keep your balances at around 30% of your limits. And what do I mean by that? Let's say you have a credit card for $1,000. That's your limit. In order for you to get the best score, you want to maintain your balances at or under $300, which is 30% of your limit. Okay. If you have a credit card that you're close to being maxed out, that account will actually lose points instead of gain points for you. Okay. Now, besides having individual accounts with this formula, 30% formula, your credit report also accounts for your whole portfolio, right? So let's say you have 3 credit cards. One, it's for $1,000, another one for $2,000, and another one for $5,000, right? So that's a total of $8,000 limits that you have. And let's say for the first credit card, which is $1,000, you have a credit limit of $300. For the other one, you have $600, which is also 30%. But for the $5,000, you are at $4,000, right? Which is way more than 30%. Well, if you make the addition, if you add 44,000 plus the $600 that from the other credit card and the $300, you're close to $5,000, but your total limits are $8,000. So you're more close to 50% instead of being closer to 90, right? So not only the credit score considers individual accounts. They also consider your whole portfolio. They take all of your limits and add them up together and all of your balances, and then they calculate what should be the percentage. So try to maintain that percentage as well, under 30%. Length of credit history, this is how long you have credit. So the earlier you start, the better. I still have the credit card that I opened when I was 18. And I don't mind sharing my age with all of you. I'm 42 right now. So it's been 24 years that I've had that credit card. It's not the best credit card I have. Right now, at this stage in my life, I have better credit cards than the first one I ever got. But I refuse to close it out because it's the oldest credit line that I have on my credit report. So what I do, I use it once a year on my birthday. I go out, I buy myself a cup of coffee, I put gas on the car, pay it off, and I don't use it until the following year. And I've been having it like that for the last 20 years or so. And the reason why I do that is because it's the oldest piece of credit I have. And if I was to close it out, even though I don't use it, I'll be pretty much erasing the credit history that I've had with that credit card. New credit, 10%. These are the accounts that you have opened that have less than 12 months of usage. And the credit score also considers these accounts. And lastly, types of credit, which is 10%. There's two kinds of loans out there, revolving loans and installment loans. And I will explain what is the difference between the two in a future slide. All right, so let's go into more detail on each one of these pieces. We said payment history was the most important, right? Most important piece. So for every 30 days past due, the score will decrease approximately 60 points. And as many of you know, credit is something very delicate. Credit, if you have, it may take very long time for you to get good credit, years. And it just takes one missed payment or one past due payment to lose points that it may take many days for you to get back. So what do I mean by that? Let's say you have an 800 score and then you lose your job and now you were unable to make a payment. Now your score could drop down to 740, 730. And in order for you to get those 60 points back, to bring your score back to 800, it may take you 8, 9, 10 months of perfect payment, in order for you to try to get those points back. Sometimes even more time. So let's keep that in mind. If you have good credit or you've been able to establish good credit, you want to try to maintain it because it's very, very easily you can lose points and it will take a long time to get them back. So you want to pay your bills on time. The longer you pay your bills on time, the better the score, of course. If you've missed payments, you want to get current and stay current. And you may ask yourself, how do I get current? So there's different ways. If you, one of the ways is by using your tax return. If you get some kind of like tax or money coming back to you, you could apply that towards a card and try to bring it current. Or if you get a bonus or you get a part-time job, there's more income coming in. Or if there isn't, then another way is for you to get in touch with your credit card company and ask them, explain your situation, what's going on, the fact that you may not have enough to make a payment. They may put you on a payment plan to get you current. And once you're current, you want to stay current. Lastly, you want to use automation to your advantage. So you want to use technology in order for you to take care of your credit and not be late or pay over the limit fees and stuff like that. You can use the online bill payment service that Affinity and many financial institutions offer to set up automatic payments and avoid being late. You're not only saving on late fees, but you're also protecting your credit. Okay. All right, amounts owed, we said it was 30%, the second most important. And with amounts owed, I mentioned the 30% formula. You want to maintain your balances under 30%. So the first bullet point here is something that I've seen many times in my career in banking, and it's sad because a lot of people are under the misconception that in order for them to improve their credit, they want to pay off their credit cards and close them out. And they don't realize that they are, instead of helping themselves, they are actually hurting themselves. And this is why. If you close out a card, you are erasing the credit payment history that you've had with that account. And if it's an old account, it's even worse. So if you have a credit card that you don't like and you want to pay it off, and you also want to close it out, once it's paid off, if there is no annual fee, for example, don't close it out. Leave it home, put it somewhere in a drawer, use it once a year, so that way the company doesn't close it out on you, right? But don't close it yourself, because instead of gaining points, you're losing points, because that credit history will no longer appear on your credit report. That's the reason why I refuse to close out that card that I've had since I was 18. You don't want to open new credit cards that you don't need. So only apply for credit whenever you need to, and not just because you want to have another credit card, okay? The next bullet point is what I just mentioned before. Maxing out your limit will decrease your score. Try maintaining your balances under 30%, okay? And then lastly, overspending high balances can lead to stress, and because credit can get out of hand very quickly. I'm sure many of you know I made a lot of mistakes when I was in my youth, in my teen years, and also in college. And I was one of the persons who just pretty much overspent, and then find out that I was $6,000, $7,000, $8,000 deep in debt, and only working a part-time job. So we wanna, if we have access to credit cards and we have access to credit, we want to be responsible. We want to use our credit. I'm not saying don't use it. It's there for a reason, right? But use it responsible, and know the amounts that you are spending. That way you can plan to pay them back, and don't just overspend without actually having a notion of how much you owe, and then find the surprise that you are very much in debt, and now you have to start making those payments and start getting out of that hole. Okay. All right, length of credit history, 15%. Your score also considers how long it's been since you used certain accounts. So I mentioned before, you want to use your credit cards at least once a year, okay, to maintain them open. New accounts lower your average account age, which affects your score if you don't have a lot of other active credit. And this is pretty much what I've been preaching all afternoon. Optimize your credit score by keeping your oldest card open and active by using them at least once a year, okay? New credit history. Your credit score also takes into account how many new accounts have less than 12 months activity history. How long has it been since you opened a new account? Okay. Also inquiries. So how many recent requests for credit you've made. So every time you request credit, it doesn't matter where, an inquiry will be created and added to your credit report. Okay, those inquiries will go away after 2 years of being reported, but they're there because there's a way for other banks or financial institutions to know where you've been shopping around for money, for credit. Okay. Now, this last sentence is very important. It's suggested you do your rate shopping for an auto or mortgage loan within a 14-day period. What do I mean by that? When you are in the market for a vehicle or a home, the federal government has said that it will be kind of unfair if you are out there shopping for the best rate, for the biggest purchase you will ever make, and every time you apply somewhere, you get dinged in your credit report. So if you are buying a home or you're buying a car, as long as it is for the same purpose, you can apply in multiple locations, and your credit score will only get hit once. So if you go to Affinity, you apply for a car loan, and then the day after you go to Chase, and then that afternoon you go to Bank of America, your credit score will only be hit once because you are applying for the same kind of loan. Now, if you apply at Affinity for a car loan, then you go to Chase and you apply for a credit card, and then you go to Bank of America and you apply for a line of credit, then you're gonna get your score will be hit 3 times because it's different products. Okay. All right. Lastly, the types of credit in use. I did mention there were 2 kinds of loans out there: revolving loans and installment loans. Very quickly, I'll go through the differences between the two. Revolving loans are major credit cards, retail store cards, lines of credit, and overdraft accounts. Installment loans are your mortgages, your auto loans, student loans, personal loans, debt consolidation, and timeshares. Okay, there's 3 main differences between the two. The first one, a revolving loan has no end date. So as I mentioned to you guys, I still have opened that credit card that I opened when I was 18. That was 24 years ago. I could have it forever as long as I manage it correctly. Okay, so no end date for revolving loans. Also, revolving loans have a variable rate, so the rate may fluctuate with the market. Okay, may go up or down. And also with the revolving loans, the payment may change. So depending on your usage, the payment will be higher or lower month after month. Okay. With installment loans, it's the total opposite. Installment loans have an end date. They do have an end date. They're called closed-end loans, which means that, for example, an auto loan. An auto loan, you get it for 3 years or 4 years or 5 years, right? After those 4 years or 5 years of making payments, you don't have to make a payment again. You're done with the loan. You get your title in the mail. Okay. So those are closed-end loans, have an end date. Same thing with a real estate. You get a mortgage for 20 years or 25 or 30 years, a conventional loan. Also, being the total opposite of a revolving loan, the interest rate on an installment loan is fixed. So the interest rate is never changes. So same thing with a car loan. A car loan, if your payment is going to be $250 a month, that will be the payment for the 5 years, because the rate doesn't change and the payment doesn't change. Now, there's loans out there that may have a variable loan, but mostly all installment loans have fixed rates. Okay. And lastly, an installment loan, okay, fixed payment, fixed rate, and fixed term, right? So everything on installment loans will be kind of like fixed, and pretty much everything on revolving loans will be variable. Okay. Tips for raising your score: if you already have some credit file established, when you check your own credit report, you will not be affected. Okay. So if you sign up for those services such as Credit Karma, or you go into annualcreditreport.com and you put your credit on yourself, you will not lose points. You're doing it for information purposes. You're not actually asking for any credit to be extended to you. So with that said, you want to get into the habit of monitoring your own credit report at least once a year. Everybody's entitled to 1 credit report per year for free. You can purchase additional reports throughout the year if you want to. I think they're like somewhere like 10 or 15 bucks per report, but you are entitled to at least once a year for free. Okay. As mentioned before, you want to apply for and open accounts only as needed. Have credit cards and manage them responsibly. How? By making payments on time, by not being late, by not being over the limit, by keeping your balances under 30%. Okay, having good credit leads to easier access to borrowing, less time worrying about bills, leaves more time to enjoy life. So what's a good FICO score? So the range for the score goes from 300 to 850. But there is no sure score cutoff to say what's good and what's not good. Okay, it all depends on what's being offered, right? So let's say a dealership may say that 0% for premium clients or well-qualified clients. That means that people that have a score over 800 get 0%. That could be at the Lexus dealer, for example. But then you go to a Toyota dealer and people there are getting 0%, perhaps not at 800, but perhaps at 780. So what's having perfect score? You know, it's relative to what you're trying to buy and where you're going. So if you're trying to buy a Lexus, a perfect score, or the score that will actually get you the best rate is at 800. If you're buying a Toyota Sienna, it's at 780. So it all depends on what is being offered, right? But just to give you guys some perspective, this is kind of like the average of those numbers. So a poor score will be somewhere between 300 and 619. A fair score will be 620 to 679. A good score will be 780 to 739, and an excellent score will be 740 and above. Okay. Again, don't hold me to these numbers because it depends on what you're buying. Now, the bureaus that are in charge of putting together your credit score report are Experian, Equifax, and TransUnion. And as you guys can see here in this graph, if you find yourself all the way to the left, there's a 0% there, and it says highest risk. If you have poor credit, there probably will be a 0% chance of you getting a loan because you pose the highest risk to the financial institution. All the way to the other side of the spectrum, if you're at excellent and you have 100%, that means that you will get the loan as expected, but because you pose the lowest risk to the bank. Now, if you find yourself in the middle, where it says 50%, where it's between fair and good, you may get the loan. They may ask you for a cosigner, or you may get it, but perhaps not with the best terms. So maybe you will not get the best rate out there, but at least you get the loan, okay? Now, improving your FICO score can help you obtain employment. This is very important. More and more often, jobs out there are pulling people's credits to see how they are, how responsible they are paying their bills. A credit report talks volumes about the person, and hopefully it will talk good things about the person and not bad things, right? So if you pay your bills on time and you're never late, that shows that you are somebody responsible, and that speaks good about your character, okay? Also, having a good score can help you rent an apartment, set up utilities, borrow money, live a stress-free life, get a better credit offers, lower your interest rates, speed up credit approvals, and feel financially secure. So all of these are benefits that come from enjoying or having a good credit score, okay? How do you get your credit report? So there's 3 ways. Annualcreditreport.com. It's a great website. I love it. That's where I get my credit reports from. It's kind of like a portal, and this portal will allow you to get the credit report from all 3 credit bureaus at the same website. And also, it's a great website because it doesn't sell you any services, credit monitoring services or anything like that. Okay, you can also give them a call, or you can reach out to each bureau directly. I've added the website for each one of the bureaus down in the bottom, and request your report from there for free. Okay. All right, very good. So how long does it take to repair my credit? So I love this slide. By the way, this is the last slide of the presentation, but I love this slide because it really puts into perspective how serious it is to not be able to manage your credit. Okay, so as you guys can see, there's different instances or different places where people may find themselves into having late payments, foreclosures, collection accounts, short sales, bankruptcies, repos, judgments, tax liens, and charge-offs. Okay, as you guys can see, 7 is the magic number here. Each one of these instances has a 7 attached to it. And that 7 means that it takes 7 years to erase that blemish or that negative mark on your credit report from the date of you getting it. Okay, so the only one that is kind of different here, it will be a bankruptcy. If you file a Chapter 7 bankruptcy, it's actually not 7 but 10 years from the filing date that you will get the bankruptcy erased from your credit report. If you file Chapter 13, it's 7 years. Okay, so if you have negative information on your credit reports, it can take a while for it to age off, as you guys can see, at least 7 years or more. If you have inaccurate information, you may be able to dispute it and update the information. How do you know if there's inaccurate information? Well, the way you will find out will be by checking your credit report regularly, at least once a year, if not more. So once you put your credit and you see what's being reported, you should be able to recognize every entry in that report. And if there's something that seems off or is not yours, this is when you should be contacting your credit report to dispute information, because it's definitely it's either being misreported or unfortunately you may have been victim of identity theft, and there's credit cards out there that are not yours but somebody took out under your name. Okay, so that's the importance of checking your credit at least once per year. Okay, all right, very good. So this brings my presentation to an end. I would like to pretty much open up the floor for any questions that any of you may have. That's what I'm here for. Next week's webinar, it's going to be on, let me take a look. Next week is on annuities, retirement planning, and more. So this is a great topic to learn from if you guys are looking to start planning your retirement or leave a legacy. Okay. So the reason why I say next week's webinar is because I don't know if I mentioned this before, but you guys will receive an email in the next, want to say maybe 20 minutes or so. And this email is going to thank you for attending. You're going to be able to receive a link to rewatch this presentation if you want to. And also you'll receive a link to register for next week. So hopefully I'll see everybody next week on the next installment of the weekly webinar. Okay. So there are a couple of questions being asked this afternoon. Let me go ahead and open them up here. All right, very good. Why does my credit score show that there are too few accounts currently paid as agreed? All right, so I think that those are two different questions. So why does my credit score show that there are, and there's let's see if there's a follow-up question. So no, so there isn't. So Valerie, if you can please just elaborate a little more on that question, I'll be more than happy to answer it for you. Let's go to the next one. Since different credit cards offer different kinds of benefits, is it worth to have 2 or 3 credit cards that provide different benefits that you actually use or benefit you? Or is it better to have 1 or 2 credit cards that potentially sacrifice potentially use of benefits? So thank you so much for this question. It all depends on what you want to do with your credit. So if you are a person, for example, I have a credit card that gives me cash back, and I also have another credit card that gives me miles for traveling, right? So I like both of them. I use them both, and I pay them off every month because I'm pretty much taking advantage of the reward program. So you can have multiple credit cards depending on what you really like. There's credit cards out there that offer points, and you can redeem for gift cards. Perhaps you like to shop or shop and you can get gift cards. If you're a traveler, then a credit card that provides miles will benefit you. Is it worth it? it all depends on you, on how you manage your credit. As long as you're making those payments on time, as long as you're managing those balances and keeping them under 30%, as long as you are able to pay them off, or if not, make as much of a payment every month, and you maintain your credit intact, I don't see the harm in having multiple credit cards that give you different kinds of benefits. Okay. It all depends on your lifestyle, pretty much. But the purpose of this webinar is to pretty much emphasize the importance of maintaining good credit. So I would say I have a couple of myself, and I also have that one that I opened when I was 18 that didn't have any reward program. So I'm not really interested in using that one at all. But I use the ones that do give me something back. Okay. Next, once you pay off your loans, like student loans or mortgages, how long does it stay on your credit report, and how long and how does it impact your score? So when you pay off loans, those accounts will not will have some kind of effect on your score for the next 2 years, because usually your payment record on any account is for the last 2 years. So if you pay off a student loan, for example, for the next 2 years, that payment history will have some kind of effect on your score. Okay, hopefully it's positive and you paid it off on time, right? After 2 years, it will be listed on your report as something that was paid off, but the impact that will have on your credit score will be minimal. Okay. Now, hopefully that's why when a lot of people pay off, say for example, a car loan, it doesn't take very long for them to apply for a new one, right? Because they're used to making payments toward, and it's part of their budget to have some money aside for a car loan. Okay. All right. Thank you so much for that question. Let me go to the next one. I'm 24 years old right now. Would you recommend attending next week's webinar on annuities? I absolutely recommend it, because it's never too late to start thinking about retirement and start thinking about what will happen after you stop working in annuities and other investment products. I wish I would have gotten information when I was in my 20s, because otherwise I would be pretty much have a lot of money saved up for retirement at this point. I started saving for my retirement when I was in my mid-30s, and I wish I would have started earlier than that. So if you're 24, it's only about an hour. So what's an hour to you? Perhaps a lot. I don't want to say that time is not important, but perhaps this hour will open up your mind to learn a little bit something different that you will definitely be interested in later down in life. But the earlier you get the information, the better. Okay. Thank you for that question. Is there a maximum number of credit cards? I've seen in my experience in banking, I've seen people that have had 20, 25 different credit cards. So I don't think there's a limit, maximum numbers of credit cards that you can have. It's pretty much how you manage them, right? So personally, I have six credit cards right now. I mainly use 2. The other ones are ones that are store cards or old credit cards that I don't use, but I don't want to close them out because, again, I don't want to lose the benefit of the history that I've had with those cards. Okay, but I don't think there is a limit of how many cards you can have. Okay, my credit score says there are two fee accounts currently paid as agreed. I am confused because I have never paid anything late. Okay, so thank you so much, Valerie, for clarifying that question. So it says too few accounts currently paid as agreed. So again, let me pose this question back to you. When was the last time you checked your credit score? perhaps, and I don't want to jinx anything, but perhaps there may be accounts there that maybe they're not yours, or maybe they need to be disputed, or there's something that is being wrongfully reported, and that's an account that you may want to bring up to the attention of the credit agencies and dispute. So it could be anything. I will have to see your score more closely to perhaps see what is the reason why. But usually when there's a message like too few accounts currently paid as agreed, and you know that you never missed a payment in the past, there 9 out of 10 times is that there's something being reported in your credit report that shouldn't be there. Okay. All right. That you can have for, okay. If your credit score went down due to a large change, would your score go back up once you get your credit limit back to under 30%? It will start to go back up, but it doesn't happen automatically. So that's why I mean during the when I said during the presentation about losing a lot of points by committing just one little change and then taking a long time to get those points back, that will be the case. So if you score went down due to a large change, that unfortunately it did, if you maintain your amounts under 30%, you will see that little by little you start getting those points back. I don't know how many points did you lose, but I know for a fact that they don't happen from 1 month to the next. You won't get those points back right away. It may take a couple of months for you to do that. Okay. All right, great. Let me see another question. If I make a partial payment in the middle of the billing cycle for a credit card and then pay off the rest of the payment when the credit card bill is due, how will it affect my score? Actually, it won't, because what happens is, like, if you make a payment mid-month and then you complete the payment at the end of the month, the credit agencies report by the cycle. So if you within the same cycle, if you completed the payment, on your credit report, it'll just show that you paid on time. That strategy is very useful for mortgages, for example, and not so much credit cards. And the reason is because if you make a payment mid-month, like half of the payment mid-month, and then you complete the payment at the end of the month, you are pretty much staying ahead of the interest being charged, because usually mortgage interest is calculated on a daily basis, but credit is not. Credit is the interest charges on a credit card are added at the end of the billing cycle. That's why you get a chance to, if you buy something, to pay it off completely before the end of the billing cycle to avoid interest. So you can pretty much pay it off whenever you want to and not be affected. Okay. Thank you so much for that question. All right, let's see. If a vendor promised that they will issue a $450 refund on my credit card, but I don't see it issued or reflected, what solutions are there so that I'm not responsible for paying that $450? All right, so there's a couple. First, you need to get in touch with your credit card company, and you want to let them know of what happened. You can dispute the amount, and they'll issue a provisionary credit on your credit card until they do an investigation of what happened. Now, it wouldn't be considered fraud or a fraudulent transaction because you are aware of that transaction and the vendor promised you a refund. So the transaction wouldn't be a dispute, a fraud dispute, but it still be a dispute because it's something that you were promised and you haven't seen. It also depends on how much time has lapsed, right? So if they just promised you that last week and it hasn't happened, your credit card company may say, you know what, let's give it another week. But if it's been a long time, then you can definitely dispute it. Something else that you can do is you can go back to the merchant and you can just let them know that you're still waiting for your credit back. and that you will dispute it. So at the end of the day, they cannot keep money, like they cannot steal your money. Like if they promise you a refund, then they'll do it whether they like it or not. If whether it's voluntarily by them doing it or by your credit card company demanding the money on your behalf. But you definitely want to get in touch with the merchant, and you want to get in touch with the with your credit card company or financial institution. Good. Will you be sharing the recording? Absolutely. As soon as this webinar is complete, I will share the recording with all of you in the follow-up email that I will be I will be sending over to you. Okay. All right. So there's still a couple more that you can have for not affecting your. Okay, I do have kind of like segments of questions, not a full question. So from Valerie, I have, why does my credit show that there are? And then I have two other follow-up sentences that perhaps I'm not putting together the question in full. I also have too few accounts currently paid as agreed. I think these are just comments as I'm answering the question that perhaps some of you have just added to the queue. All right, so very good. So that concludes the presentation. I don't see any other questions being asked right now. So I want to thank everybody for attending. There's still 30 of you still on. So thank you so much for staying until the end. I hope this was informative. I am to the follow-up email that I'll be sending you guys. You guys can respond back with any questions that you guys may have. And I'll be more than happy to find the answer for you if I don't have the answer. If I have it, I'll respond right away. But if I don't, I'll try to get the answer for you from the different departments in here at Affinity and get back to you. With that said, I hope to see you guys next week on the next installment of the weekly webinar. Thank you so much, everybody, for joining me, and hope to see you next week. Also, there is at 6 p.m. this afternoon, I'm starting the home buying webinar series. Tonight will be the first part of the series. So if any one of you is interested in buying a house or is currently in the market, this is a webinar that you don't want to miss. So I'm going to be sending the email in the next 20 minutes. And if you're interested, get back to me right away, or visit our website on the events and webinars page and register for tonight's webinar if you don't want to miss out on learning about home buying. Okay. With that said, thank you so much. See you guys next week. And thank you for staying on and paying attention. I hope this was informative. Have a wonderful evening, everybody. Bye-bye.